Hi, I'm Michael Yardney, and we've enjoyed a few good years in property, but now the cycle's started to mature and some uncertainty surrounding the extent of potential future capital growth. So I think it's important to remember it's not so much the outside world that's going to define your property success in the future, but the place we take in this outside world as investors. There's always going to be forces working against us over which we've got no control. Politicians will keep making policy changes, interest rates are going to go up or down, and the world's going to keep turning without much regard to our personal plans. So in order to navigate through these changes, in order to get you through the obstacles that are going to crop up, we need to prepare in advance to weather these difficulties, those that are going to inevitably get in our way. So today I'd like to look at 6 strategies that could help you reach your property investment goals, irrespective of all those external forces that are occurring. The first one is to invest in your knowledge before you invest in bricks and mortars. Clearly the best place to start investing is yourself. However, with so much information out there, it's hard to know who to listen to, isn't it? I suggest you learn from others who've not only achieved what you want to achieve, but who've actually maintained their wealth over a number of cycles, over a long period of time, not just during the last property cycle, because a rising tide lifts all ships. I think you should also surround yourself with like-minded people. I suggest you get yourself a mentor, one who's not only going to inspire and challenge you, but one who's going to hold you accountable to your actions. The second strategy is to marry your investment plans with your investment capital. There's little doubt interest rates are going to rise eventually as our property cycle moves on and as the economy improves. And that may cause capital growth to slow down a bit. This means some investors, those who've bitten off a bit more than they can chew, will come unstuck because they've overcommitted financially. Sure, it's exciting to have big dreams, but if the path to get you where you want to get to is paved with gold that you simply can't afford, then your dreams run the risk of becoming dilemmas. Remember that all booms come to an end, and we're heading towards the peak, the more mature stage of this property cycle, probably not the peak just yet. So I think you should enjoy the current phase, of course, but be prepared for what lies ahead. The third strategy is to use your portfolio to reduce your risk. Strategic investors look forward to the best of times, but they protect their portfolio through tough times because they know they're inevitably going to come. Rather than gearing to the max, they take a more prudent approach by building an emergency buffer, by having a financial buffer. That'll buy them time to ride through the storms. These could be lines of credit, offset accounts, things like that, which you can use to call on when you've got an unexpected loss. Maybe it's employment, maybe it's prolonged illness, maybe it's an unforeseen repair, an extended vacancy. Something's going to crop up. Strategic investors also own the type of property that's going to remain in continuous strong demand by a wide demographic of owner-occupiers. That'll be in our big capital cities because these are the locations underpinned by multiple pillars of economic support, and therefore values there won't fluctuate as widely when times get tough. The fourth strategy is to do your due diligence before you do the deal. While the average investor buys their property emotionally with their heart, sophisticated investors have an investment plan, one that they adhere to and carefully evaluate any potential investment opportunity in light of their long-term goals. Strategic investors know that they make their best decisions by being less emotional, and their results are more consistent and predictable because they've got a strategy, because they've got a plan. The fifth strategy is to keep your sights set on the goals. While most investors buy a property and hold it for the long term, strategic investors regularly review their portfolio. They will see how the performance is going in light of their long-term goals. Currently, many are evaluating how their properties are going to perform if interest rates rise 1 or 2%, as many economists predict is going to happen next year. This means some are considering selling up secondary properties, those sort of properties that are likely to languish in the next stage of the property cycle. I'd like to look at my property's portfolio's performance, I guess, once a year. Are my properties performing to expectation? Are they going to keep outperforming? If that particular property was for sale today, would I buy it again? Does this property fit in with my overall plan? You see, over time, you grow, your skills improve, your circumstances change. Treat your property like a business and evaluate your assets dispassionately, and then take appropriate action. The sixth strategy is to remember that in real estate, less is often more. The person who ends up winning in the end is not the one with the most properties. And contrary to what you might believe, owning heaps of properties doesn't necessarily mean you're going to have financial freedom later in life. What I'd like you to concentrate on is getting the best deals for your investment goals, not the most deals. When it comes down to it, capital growth is key in building your wealth through property investment, through real estate. And that's why you've got to find properties that outperform the averages in the long term. And they'll always come at a price, but it's a price worth paying. The trick is to avoid cheap and secondary properties. You make your money when you buy a property, not by buying it cheaply, not by getting a bargain, but by buying the right property. Hopefully your investment journey is going to be a long one. However, this means you are likely to encounter some ups and downs, some good economic times, some difficult economic times, some periods of high interest rates, some periods of low interest rates. There's going to be booms and there's going to be flat times in the property market. Remember to prepare for the worst while hoping for the best. In other words, maximize your upside while at the same time covering your downside. And if you do that, you're going to remain in control of your destiny. If you'd also like to get a good team around you to help you achieve the goals you've set yourself, why not have a chat with the team at Metropole Property Investment Strategists? We've got no properties for sale, but access to every property on the market. What that means is we can evaluate your current property portfolio's performance, or we can help you get started in the property game. Why not have a chat with us?